Hi, good morning, everyone. Welcome to today's webinar. My name is Sophia. I organize Spectrum events for you, covering topics on emerging trends and future-focused ones to build and bring the community together through learning at Spectrum. For those of you who are new to Spectrum, we are located at Duo Tower. We provide event spaces, curated workspaces for the community experience, and enable connections for business expansion. So today's webinar is on the rise of cloud kitchens. How will this trend impact F&B in Singapore? So to tell us more, I'm very excited to have Adrian Debaye, co-founder and managing director of Salad Stop. Adrian has worked in the hospitality industry for many years. He also recently held the position of vice president, development and acquisitions with Kingdom Hotel Investments, spearheading all investments for the group in China. So in 2009, Adrian and his father felt the need for healthy food options in Singapore. And today, Salad Stop operates over 50 outlets across Singapore, Hong Kong, Vietnam, Malaysia, Japan, Korea, Indonesia, and Spain. So he'll be telling us more about their venture into cloud kitchens, which is also concept has attracted commercial real estate developers, investors, hospitality businesses, and startups who are amongst our audience today. So participants, if you have any questions for Adrian, please post them onto this platform here, and Adrian will address them after his presentation. So without further ado, Adrian, over to you, please. Thank you.
Thank you, Sophia, for the introduction, and great to be connected to everyone here. I think this is an exciting topic and really looking forward to some of the discussions later, as I see that we have quite a few people from different sectors in the industry. Okay, let me just share my screen. All right. Okay, so today's discussion is on cloud kitchens, and I'll be covering the following three areas. So first is an overview of our journey so far in the cloud kitchen space, and just to give you a sense of, I guess, what we've learned over the last 6 months, especially with COVID. Then looking at the emerging trends in the cloud kitchen space, and lastly, sort of sharing our views of the space and how that might evolve for F&P operators. So let me give you, I guess, a little bit of background first on the company. We first started with simply providing a healthier option. So people were looking for something a bit different, and we were really just addressing a need in 2009. And that evolved into creating a movement built around ecosystems and communities. So we started seeing a lot of people ask questions about, where was our food sourced from? If there were any pesticides, was it organic? And now more and more, we're really looking at creating a generation of transparent tech-enabled health food brands with the utmost respect for the environment. So Salad Stop is actually part of a multi-brand company called Fresh Creation Holdings. Salad Stop, which a few of you might be familiar, is really focused more on sort of functional healthy. Hebo is the feel-good healthy, so we do warm grain bowls, and that sort of has, I guess, wider appeal. It's all warm toppings, and also actually at a lower price point. Wuxi is your more lifestyle healthy. It's a very young, fun brand serving maki rolls, and all three brands allow you to customize. So, we believe a lot that personalization is important, and in the health space, very few brands are able to do what we do. Then we also actually launched another brand called Smusha. This is a whole food smoothie kitchen. So we launched this exclusively with Deliveroo during COVID. Obviously, as we entered circuit breaker in April, we had some excess capacity, and it was the perfect time to actually just test a new product, especially online. I think we were able to just work very closely with Deliveroo on targeting the right audience and then making sure that this product also had very minimal wastage. Most of the items are frozen or dry items, so we were able to manage that quite well. This is our presence right now. So 59 outlets in 8 markets. Like Sophia mentioned, we've grown in majority sort of around the region. Spain is a little bit off that map, obviously, but the focus is in the neighboring countries, and especially in Indonesia and the Philippines. So that's where we're seeing the most growth for Salad Stop right now, and where we're very excited about what the other two brands can bring to those markets. Okay, so COVID has impacted the F&B industry in quite a substantial way. April 2020 saw 53% dip in sales, restaurant sales by 67%, and really that's all then just shifted over to supermarkets. So about a 75% increase in sales for supermarkets in that month. The slightly worrying trend for a lot of F&B operators now is that the industry hasn't picked up, has picked up obviously a little, but since the end of phase one, and as we've entered phase two in June, the month of July and August were pretty much almost 30% off year on year. And so that's a little bit more disproportionately felt, I guess, in food caterers. They have obviously seen a lot of their business disappear with people not going back to offices or holding large events, and the restaurants though as well. So I think the food court operators and fast food outlets have been able to weather the storm a little bit better, but in general, I think it's still had a pretty detrimental impact. And as we continue into October, November, if the phase two continues in this current format, this is what the F&B industry has to grapple with. So obviously, what this has happened is a lot of people have shifted online, and this is just to give you a sense of what the impact has been on our business. We used to be about 25% online. So a majority of our sales actually just coming from in-store traffic, people coming down from the office buildings. And we didn't really have to do that much in terms of digital marketing or really pushing our online sales. I think most of those just grew organically over the years. But COVID threw all of that upside down. We basically flipped the model over. We went to 70% online over circuit breaker. And now we've sort of reached a more stable level at about 50-50. We've been very fortunate that we've actually been working for the past 5 years with various different delivery companies. So this is not a new game for us, but definitely is a model that we need to continue adapting to. And obviously the whole industry has had to shift in this direction. Just to give you a sense of also our international markets, just look at the next slide. The international markets have sort of seen a similar trend. In Hong Kong, and this data is only till April, but just give you a sense of obviously how things kind of shifted in the beginning. But we saw a similar shift in our markets. Hong Kong was the one that actually bounced back the quickest, and even up today actually is performing quite well. But everything else, work from home, we are very exposed to that, obviously, with our outlets in the central business district. But again, for most operators, this was a trend that they witnessed throughout that period. So what have we learned in the past 6 months? One is obviously work from home. A lot of people have started just ordering more delivery. People have become sort of bakers, home chefs, and also looking for healthier options. We've also started seeing, obviously, that the safe distancing measures have started leading to a greater divide between the need for convenience on one side. So again, people looking for more deliveries and more experiences. So I think people are looking forward to going back to a restaurant and dining out and sort of going through that experience. Creation of virtual brands and transforming those into cloud kitchens by necessity. So we've seen obviously a lot of people just learning and then transforming a lot of their kitchens into some virtual brands, or in some cases not having any in-store traffic and having to completely shift online. Emergence of third-party logistics. So we've also been able to work with new providers such as Lalamove, and that's also been a big shift. And before we were relying very much on Deliveroo, Foodpanda, Grab in Singapore. Now this has opened up things quite a bit for us with third-party providers. I think on the business economics, and that's, I guess, obviously been the interesting discussions for a lot of us. How does the model work moving forward? How do you continue paying your rental and at the same time high delivery commissions? And that's where we now get to a point where the model just doesn't work anymore. We have to rebalance things if this is the new norm. And those are the discussions that we're starting to have with landlords in Singapore and internationally. I think it's the same conversation and something that is going to fundamentally change the industry. And then obviously for us, it puts a lot of things into question. How do we optimize our real estate strategy and how do we grow from this point onwards? So, coming out of COVID, will we be looking at more cloud kitchens? Will we be looking at a hybrid model? Or will we think that things go back to normal? We think that the cloud kitchen model is interesting. We're going to learn quite a bit over the next few months. But that does obviously put a lot of our other existing stores into question as well. Okay, so during circuit breaker, again, we were fortunate enough that we shifted all of our stores online and we were able to deliver island-wide. So with that, we were able to see where do our deliveries go? Where do people live? Where's the catchment, I guess, for Salad Stop at least. And then from there, we started dissecting the data in a little bit more detail and saw that actually a lot of our orders were coming from the east. Some of it in the west, Bukit Timah, and then a lot of sort of around Ang Mo Kio and even up to Punggol. So when we started looking at things in a bit more detail, we saw that there was actually in the east an area that I guess covered a big part of the radius that we needed to target, and that included a street that some of you might be familiar with. Tanjong Katong Road is quite a foodie street. You have Punggol Nasi Lemak there, you have the famous chicken rice right across, and you also have Delivery Editions Kitchen and Domino's and Pizza Hut. So when we saw that, we thought, well, if we were to locate ourselves on this street, we'd probably be in good company. And if these guys have figured out how to make the delivery radius work, we can probably do the same. So we then went into a space where we actually combined all 4 brands, which was a first for us. We had never actually operated all 4 in one space. But the beauty in this is obviously customers are able to choose from 4 different brands in one basket. So we settled on a shop house, 228 Tanjong Katong Road, and we transformed an old Chinese restaurant into our first cloud kitchen. We have opened it up over the last few weeks to some walk-by traffic, but that was not the business case. We really looked at it purely from an online lens, and then we already knew basically how much we were delivering to that area, and from there we're able to determine where our break-even point. And so we thought, well, if that's already what we're delivering to the area, based on this rental and manpower costs, this is what we'll be able to achieve if we add another 3 brands to this space. So the cloud kitchen has done extremely well. We've been operating for about 2 months. We've learned a lot how to operate 4 brands in one space. I think in terms of cost utilization of ingredients, trying to optimize the labor model as well. So I think just with this space alone, I think we're starting to see how our own cloud kitchen would work in the future. And then also obviously how, like I mentioned before, how the changing footprint would also impact us. So, right now we've covered the East quite well with this location, but we definitely see a lot more demand for a similar concept across the island. We've also become a lot more efficient. So this is just to give you a sense of the sales per man hour, which is something that we track very closely. In sort of early September, and again, we've only launched this since the 2nd week of August. So just in the month of September alone, we actually were able to make the cloud kitchen actually the most efficient space out of any, well, the other 2 top ones, I guess, are Great Wall City and Capital Tower for this ratio, but we've already been able to really maximize the potential. So I think we still have ways to go. I think we know how to fine tune the model at this point, but it shows that you can really run a very efficient operation if you know how to set it up and if you are not sort of distracted by walk-in customers and can focus on also increasing your basket size, which is what I'll sort of discuss a bit later on. Just to give you an idea of also how we've continued on this trend with other markets. In Jakarta, actually in the last 6 months, We also opened 5 cloud kitchens. And Jakarta is only with Salad Stop, but we were able to basically target locations where we knew at some point we were probably going to open an outlet. But for now, we're maybe not completely convinced that those areas had enough demand. So the cloud kitchen model was perfect for that. We opened with very little capex required, and we're able to target locations which, as you can see from the map, are quite spread out. You know, they really go after very specific neighborhoods, and that's where we knew there was some demand, but I think we've been pleasantly surprised by the numbers we're seeing right now, and again justifies in the future turning some of those into fully fledged stores. Yeah. Okay, so just for us on the cloud kitchen model, I think, and I'll get into this in a bit more detail, but you know, it has to be a low base rental because you're obviously paying a big part of your cost structure is a lot obviously shifted to delivery commissions. We also see moving forward that a hybrid model could work. So I think operationally we just need to kind of fine tune that a little bit, but where your in-store sales cover your rental. I think it also becomes interesting to see, you know, how we could operate something like this in larger spaces. So, you know, industrial parks, other office buildings where you might not have the demand in the evenings or on weekends, but it's still a good delivery radius, and you can again rely on some in-store sales during weekday lunches, but then those other shoulder periods you can really drive the cloud kitchen side. And then lastly is really optimizing the delivery cost. So trying to make sure that on our side we can really push these collective orders and increase the basket size, and then, you know, try to reduce the delivery cost with a single drop. Okay, so this is just to give you a sense of the P&L for an average restaurant, and I'm really generalizing this right now, and in a way, as you saw, you know, a lot of restaurants, even up to today, let's say, have a 30% online split. The key in this, and you know, a proprietary kitchen would be similar to what we would have with, let's say, 100% revenues generated from online, and then, you know, delivery aggregator. Let's say if you were to go to Delivery Editions or one of the Grab kitchens, there you're working with one operator, one channel, one sales channel, but again, purely online. So the food cost is sometimes a little bit lower in the pure online space because most operators will charge a little bit higher. On the labor cost side, I think as you keep working in the cloud kitchen space, you obviously don't have the front end to deal with, so you can optimize the labor cost. And with the delivery aggregators, many times they actually help you with that last, I wouldn't say it's the last mile, obviously, but also the last little bit of logistics where they'll take the food from your kitchen and then help sort things out with the drivers. But then obviously the big difference here is that for an average restaurant, their delivery commissions as a percentage of total sales is, let's say, about 8%. Where in the proprietary kitchen, you are obviously just paying your delivery companies, let's call that average of 25. Most of the time, that's a little bit higher actually for a lot of people, but 25%, that's where you have to keep your rental really low. And then with the delivery aggregators, they range between sort of maybe 35 to 40%. So as you can see, I mean, from an EBITDA standpoint, they're all similar. But these are all three models that are already optimized, right? So the numbers that you see are already running on relatively high revenues, and these should all be kind of successful models in their own right. So as you can see, they all work in their own ways, and I'll dive into a little bit more detail, at least from an F&B operator's perspective. Which one would you choose for what purpose? So obviously for restaurants, the biggest advantage is you still have that foot traffic that you can rely on, but you have high fixed costs. So your rental, you can't really change. It's not a percentage-based model most of the time. For the proprietary kitchens like we have, you have the benefit of working with every delivery partner, so you're not just plugged into one. But obviously the biggest drawback is you have to then invest in all the capex yourself. with the delivery aggregators, they take care of that for you. And they help you also drive greater efficiency. So, their incentive as well is to obviously make sure that you're successful and that you can be efficient in their space. But once again, you are generally just working with one provider. So you can be a little bit limited in that sense on what the revenue potential can be. Okay, now I'll just kind of spend a little bit more time just on the market itself, and to give you a sense of where the online space is going, and then particularly where the cloud kitchen space is moving towards. So obviously online delivery sales have continued growing at a compound rate of about 12%. The e-commerce space as well. So, sometimes it's obviously through the restaurant's own technology or own app or own platform. So that continues growing tremendously. One interesting stat, at least in Singapore, is that 42% of restaurants offer delivery for the first time during circuit breaker. So you can imagine that this is very new for a big part of the industry, and something that I think people are adapting to, but some are also, really just used it during circuit breaker and are kind of going back to the old ways of doing business, which for some, I think they also understood that their products just didn't work, and it was not delivery friendly. And then, similar stat. I mean, this was through Chope, but 53% decline during circuit breaker for the restaurants that were in their network. And then, on the food delivery side, a 400% increase that is expected, at least in Southeast Asia. So as you can see with Grab and Gojek and all of these big players, they're incredibly focused on the food delivery space right now. And when you talk about the size of the markets of the Philippines and Indonesia, obviously it's it can be a game changer for a lot of these big groups. This is a table, and I'll, I can share these slides later on so you can kind of go through this in a bit more detail, but just on a very high level, this was a study done by UBS, and they, predicted that at least on a base case, the industry would at least get to about 365 billion. And that is, obviously on contrast to if it was best case for deliveries, which would be obviously a huge increase there. And then, if the whole model kind of fell apart and we would get back to kind of the old restaurant model, then that would obviously drop quite significantly. So just I've highlighted a few of the things in red there, and the big shift obviously is that the real winners in the current climate are obviously the delivery companies, but also very interesting, the industrial REITs. So, anyone that is building cloud kitchens, anyone that might be in a business park and, have a good delivery radius, those will benefit. And obviously, if this trend continues, the ones that will really struggle are the malls. So any kind of traditional business will find it difficult. And if they don't adapt in this new world, and if this trend continues, obviously they're going to struggle over the next few years. So, so interesting. I mean, you can read, this article in a bit more detail, but I think it's a very good snapshot of what is happening and I guess where the industry could be headed. Okay, so the rise of the cloud kitchen specifically, I think obviously, a lot of investors have been focused on the food aggregators in the last few years, but there's intense competition there. And I think there's also a winner-take-all mentality. A lot of the delivery companies, especially in a very small market and saturated market like Singapore, find it difficult to grow, and they're just really trying to shift the needle in very small ways. And I think the model here is still quite difficult, but from a cloud kitchen standpoint, I think it does offer something a little bit more sustainable. Again, a question there because there are a lot of new entrants coming into that space as well, and everybody's trying to take a piece of the pie. But in general, I think it has been a pretty natural evolution. You've gone from delivery aggregators like Deliveroo to obviously with all of that, as more merchants have joined, as more order volumes have come in, especially over the last 6 months, a lot more data is collected, they're able to see exactly where the market gaps are. And that's where the delivery kitchens come in. So, for a lot of these cloud kitchens, they're able to see exactly, well, where's maybe a great pocket of opportunity, where's there a shortage of options, and they plug themselves in into those locations. So I think in terms of the model, especially in this climate, I think if they're able to sustain that, I think there'll definitely be opportunities for them to make sure that they take everything that has been built in a way and just leverage off of that. But yes, it's definitely at a tipping point now, where as people get more and more used to ordering at home, obviously the dynamics will shift in the industry. Just to give you a sense of also the funding, just Cloud Kitchens, which was obviously launched by the ex-founder of Uber, just raised another 700 million in their last round. So that's a 5.2 billion valuation. I think they've only got about 50 locations, maybe a little bit more at this point. But it just shows again the interest in this space now. Even Jollibee, one of the biggest F&B operators in the Philippines, they've committed to $139 million in the Philippines, and again combining a lot of their brands in one space. Kitchen United got some backing from Google. Yummy Kitchen is growing quite a bit in Jakarta. And then obviously the giants in the delivery space, Grab, Gojek, are operating their own. And we've actually joined in on 4 Grab kitchens in Jakarta, and definitely seen that the model works really well. So, even in Indonesia, it allows us the opportunity to go into new cities without having to actually spend very much. So, if we're looking at Bandung or we're looking at Bali or other secondary cities, even as we continue growing into Surabaya, we're starting to see that actually maybe testing the market with cloud kitchens is a great way to go. Okay, in terms of emerging trends, what we're seeing is, again, a lot of vertical consolidation, and we could see this happening and being quite a reality in the next few years, is really just having your third-party aggregators starting to join forces with the cloud kitchen. So we started to see that with Uber Eats and Ando. We also see that third-party aggregators are becoming increasingly efficient. So you will see very often now a delivery rider arrive at a restaurant and actually pick up 2 bags and do 2 drop-offs. So they themselves are starting to fine-tune their model and reaching a level of profitability that I think will be interesting for the industry. I think in the long run, I think it'll be a lot more sustainable. Automation, obviously, that's what a lot of people are going to do to try to drive down those costs, and that's where automating kitchen appliances, robots, drone deliveries still feel like a little bit away, but I think you have companies like Kiatz, that's a cloud kitchen in Germany. They are really at the forefront and moving very quickly on this. So I think that will be also very interesting for us to look at how can we automate a few of our processes. Recipe improvements, I think everyone is looking at how you create more delivery-friendly recipes. And then obviously in all of this, data is king. And that's where people are looking at how do they streamline their processes, how do they really focus on digital marketing and reach out to customers online. So moving forward, obviously, the consumer behaviors are changing tremendously. Like I mentioned before, really that's on one side going to be very much driven by convenience, and on the other side, delivering an experience that is unique and that brings people to the store. Third-party aggregators are looking, and some have started developing their own proprietary brands. For some F&B operators, that is a little bit of a worrying trend because they obviously understand the game better than anyone else. And if they continue down this path, they obviously will have huge leverage over the industry in terms of funding and obviously all the data that they collect. And then I think pure virtual brands, I think the hard part of this is that there's still very high acquisition costs and retention costs. So we still believe that a hybrid model is necessary. Running a brand purely online is challenging unless you've just hit it on the nail, you've gotten all the right influencers and you are the hot new thing in that space, and you have, again, the funds or the P&L to absorb the marketing cost. But I think that's still yet to be proven how that can be effective. And again, I think will probably have to be done on a very large scale for virtual brands to be efficient, or really run on the back of existing brands. So Chili's, for example, in the US ran a new chicken wing concept and their run rate is at about 150 million right now in the US. So definitely something that works for them. But again, they're using the excess capacity in their current kitchens and running it out of there. So, when you look at the P&L, it's very different than if you were just running a pure virtual brand. Cloud kitchens are also a great testing ground. So I think for a lot of people, that's the natural kind of way of entering the space, is just to say, let me test something. I'm a very passionate baker. I feel that there's a gap in this market for this certain product, and that's a great way to just test it and to get a brand off the ground. And then I think for some operators, they work very closely with aggregators, really just to capture market share. So they might not be looking at it from a profit standpoint, but really just to grow that piece of the pie. And lastly, I think we start seeing some delivery aggregators also build kitchens now that have a pickup service and then even have seating. So using the existing technology that they've already built for delivery, it's quite easy to extend that to pickup and allow people to just swing by and grab something. So then obviously you reduce the cost, and it is an interesting model that I think a lot of people are starting to look at. Why just limit yourself to a purely online model, or at least a delivery model only? Okay, this is actually the last slide. So just from our standpoint, or at least how we see our business, I think we are fortunate in a sense that with all the brands that we have built, they're very delivery friendly, and that continues being our focus. We're not really focused on creating the same experience as a fine dining restaurant, obviously, and I think we're trying to learn as much as we can about how we need to adapt our products to be even more delivery friendly. I think fundamentally, F&B groups will need to continue focusing on their brands and product, because that is the one thing that makes them stand out and is difficult for anyone else to replicate. We are fortunate, again, that we have built a brand over the last 11 years in Singapore, and in other markets such as Jakarta. The saving grace for us over the last 6 months, as most restaurants have really struggled to go online, is that we are a recognized brand and people trust the product and quality that they receive. We also believe very strongly in building our own technology, and that's to continue collecting some of our own data, but also really to push ourselves to really understand this space and making sure that we can own some piece of that pie. We don't want to just purely rely on third-party providers, but also make sure that we can do some of it ourselves. And in some ways, we feel that we also have certain customers that look for an experience that's a little bit more unique and that needs to be tailored a little bit better. So again, building some of our own technology makes sense, and some obviously especially with the aggregators, we continue working very closely with, and they've added a lot of value to our business over the last 5 years. And with technology, obviously, comes data, and that's been a big focus for us. So really ingraining that kind of data-centric culture in our organization has been key, and really making sure that every decision that is made is always data-centric. And then I think, again, going back to a little bit the technology, we want to make sure that we also own more of that user experience. Sometimes when users are directed to a third-party site, we actually don't collect any data after that. So that's difficult for us. We can't retarget them. We don't know who they are, and we rely purely on third parties to give us that information. And lastly, I think for us, we still believe in the physical presence. We still believe that you need to build an emotional connection with customers, and that emotional connection does lead you to something that's also greater online. And our challenge in the future will be about equating that experience, that in-store experience, with the online experience. And I think that's our challenge at this point, is how do we make it seamless? How do we run an operation that can handle both sides, which is very complicated for some, especially like in our instance where we have a huge lunch rush, and then at the same time we have a lot of online orders. So all these things I think are still a little bit fluid for a lot of operators, but we all need to move very, very quickly. The industry is changing drastically, and I think the funding is heading in this direction as well. It's very, very clear that the investments made recently in the cloud kitchen space are a very clear indication that this is kind of the future, and I think customers, again, they're demanding that convenience now. So it's up to us as operators to really kind of lift ourselves and make sure that we can deliver on those promises. So that's the end of what I have in terms of slides. I'm happy to take any questions, of course. And back to you, Sophia.
Thank you, Adrian, for that great sharing. So I have to apologize because right now there's some construction going around my area. So I'll give more airtime to Adrian as well. Adrian, perhaps you would want to share. We've heard about the business side of things as well, but we want to hear your personal journey. So please share with us more on that.
Sure.
How you started, from which industry, and then to where you are.
Sure. So I grew up in Singapore. This has been home for the last 30 years. So went to school here, then went off to the US to study, came back to Singapore, and then lived in Hong Kong, worked for a consulting firm there, and then joined a hotel investment fund. And I was based out of Shanghai, between Shanghai and Singapore. And then the financial crisis hit. And that's when, we closed the Shanghai office and the Singapore office. And that's when I came back to Singapore. My dad and I sat down. He was in between consulting gigs, and we said, well, why don't we do something? Let's try to see what we could do. Obviously, the market was just picking up in 2009. There were lots of opportunities, and we also see that next year could be a great opportunity for F&B operators to capitalize on some of these gaps. But it was the same in 2009. There were very little kind of healthy options, and you had a lot of companies move here, setting up offices. So the timing was right. The rentals were low. Everything kind of just aligned itself really nicely. We had a lot less competition, but we knew, I guess, from the beginning that no matter what, the concept that we were developing had to be scalable, number one, and number two, had to be exportable. So we really knew that if this didn't work in the Philippines or Indonesia, we just shouldn't even go ahead. That's why we localized a lot of the dressings. We tried to keep it as again, exportable in terms of the product as possible. So, sourcing ingredients locally, all of that was really important. And we've had great success abroad. I think we've been very fortunate to find some great partners. It will be interesting to see how next year shapes up, and I guess over the next few years in this part of at least the world, we're very excited about the potential.
That's great, Adrian. So audience, keep the questions coming through. So we've got one question from Cervantes Lee. Thank you so much, Cervantes. So hello, Adrian. How is the restaurant's view on third-party aggregators taking 20 to 30% of service fee?
I think in the beginning, it was difficult to wrap your head around. For us, in the early days, it was really considered as incremental sales. So when you look at it as incremental sales, you have, some fixed costs, your labor, your rental that is already covered in a sense. So then it justifies, right? It justifies that kind of margin that they would take. And we also understood that, they needed to cover the delivery cost. But I think over the last few years, we've obviously seen those revenues no longer being incremental and just literally replacing our existing revenues. But I think the reality of the situation is that a lot of customers are looking for that convenience. They're increasingly willing to pay for it. And I think restaurants also need to look at how do they build an online menu and an offline menu. And when I say that is that for most operators, their online prices are about 15 to 20% higher. And most customers accept that. They understand that there's a price to pay for that. And that's where you can work the numbers and obviously make it a little bit more sustainable in the long run. I think the big question now is it was workable to a certain extent when, as a business like ours, when we were at 20, 30%, and we could cope with that. But now when you look at a business that suddenly kind of flipped over and is now 50%, you can't have I guess we consider it an online and offline landlord expecting the same type of commissions or rentals, right? So these are now the discussions that we're going to have with a lot of landlords to say, look, the landscape has changed, and it has for many years. One of the biggest things, benefits, I guess, of COVID is that it has finally surfaced all of these issues, and now I think it's time to really have very honest conversations with a lot of the stakeholders to say, look, this is the way the industry is shifting. It will rebalance itself out to a certain extent, and we don't exactly know what that level will be, but until we hit that baseline, we need to start having a conversation. And I think finding that sweet spot is where I think, every party kind of needs to come together a little bit, and restaurants just have to figure out their model, because I think it's going to be very hard to slow down this shift towards more online, and you see it in the retail space, you see it in a lot of other industries. So I think the restaurants need to also, I guess, accept the fact that this is the future, and they need to start adapting themselves to that new reality.
Great, thank you. So which brings us to the next question from Blair. Thank you, Blair. It's easy right now to get sucked into believing delivery is the only way forward due to distorted numbers from COVID. Post-COVID, what do you expect the split to be?
We would expect, at least maybe in our business, to maybe be 60% in store, 40% online. A lot of that also will be driven by just maybe opening a few more cloud kitchens. So obviously that split will be skewed by that, I guess, move that we would be embarking on. But I think for most of the industry, and again, I think it's probably, you need to break it down a little bit by sector. I think, there'll be some restaurants that don't need to, they'll be full on a Friday night, Saturday night. They don't need to switch on the delivery tablets. They just don't actually have that capacity, and they're not built for that. So I think for some, they'll go back to almost the same model as before. But I think for most, and the ones especially that learned how to tweak their menus, how to create virtual brands, I think they're just going to start seeing that their kitchen layouts will need to change. All of that will need to shift. So I would say that, yeah, the industry will probably start looking at 30-40% of their business starting to move online, at least in the fast food kind of space.
Thanks, Adrian. There's a question from the audience as well. How does the supplies procurement work in cloud kitchens? Do they partner with retail suppliers for ingredients, or do they produce ready-made meal which can be upscaled a bit? For example, mixed together, heated, and sold to increase ops efficiency. Great question there.
Very, very good question. And this is, I think, where a lot of people are exploring all these different models. And I think, there's some third-party aggregators that actually help you with the ordering. So they order in bulk, and they help basically the restaurant reduce their cost. If you can buy rice for 10 different restaurants that all operate in the same space, that will obviously help. So I think on that front, I think there's definitely some ways to optimize. But I think a lot of people are looking at even during off-peak hours, what they can do. Can they extend their products into catering? For us, I mean, right now we're serving our 4 brands sort of with their individual menus and with what you would get in store in a way. But what will be interesting even for us is, how do we combine different parts of all the SKUs that we have in one kitchen and create something completely different? And I think, again, there are a lot of different scenarios where, you could be catering to a big event, and we have the capacity to do that, where you could create virtual brands out of a few ingredients. So there are a lot of different things that can be done with this new model. And again, that I think is where, it's the delivery partners can sometimes, for at least restaurant operators, seem a little bit intimidating, because they've obviously gained so much in terms of their influence on the industry. But at the same time, I think they're also very open to working on a lot of these different solutions. So, they're always very excited about launching new virtual brands. They're excited about looking at different catering opportunities, etc. So I think there's also a lot of ways to work with the aggregators to find new channels, new sales channels.
Thank you. So one of the advantages of cloud kitchens is the flexible menu. So which brings us to this next question. How do you manage menu changes, or is the model geared for static menus?
A very good question. Right now, it's a little bit more geared to static menus. Operationally, it can become quite difficult at scale to have too many variations. But again, going back to one of my earlier points, I think if you are open to considering a cloud kitchen more as a testing ground, then it's like a lab. It's really just an R&D kitchen in many ways. And we operated a little bit in that sense during COVID. You know, we really just threw things out there and see what would stick. For example, we launched protein bowls during circuit breaker, and we were cooking in the store, very, very light cooking. Most of that was done from the central kitchen, but still we kind of had to change our operations a little. And those have done phenomenally well. It will definitely be part of our menu moving forward now. That's, I guess, you know, when you have a little bit of excess capacity. But, you know, if you're a single operator starting out, that's the best way, is just to test things online. It's something that is so low in capex. It's really just your marketing cost that you have to consider at that point. And a few people have done that. I think you see quite a few new concepts in Singapore that have popped up virtually, and have gained quite a bit of momentum. Now the question will be, how can they sustain that and be top of mind to customers? But there's definitely something to be done there. I think if you're a new player, it's a great model.
Great, thank you. So we've got questions from Joey. So Adrian, with the spike in brands fighting for space in the delivery world, especially with that 42% increase during circuit breaker, how much of inflation for the prices to counter commissions? And how was it like fighting a mini war with all new restaurants trying to squeeze their way in with promotions that aren't really that sustainable after the discounts, borne by the restaurants, and the same commissions from the delivery marketplaces?
Very good question. That was something that we noticed very on during the circuit breakers, that, you know, it's just it became a discount engine, really. It just, you know, it was 50% off, 1 for 1 on everything, as people were sort of out of the gate. Then you started seeing more, you know, the reasoning kind of kicking in, and then we I guess just continued on with you know, with our loyal base, I guess, that followed us, and then we did start targeting maybe non-regular customers, at least more when they're in a certain area. Then we really went a little bit more in detail rather than just doing kind of blanket discount approaches. So that's how we approached it. But yes, I think some of the algorithms for delivery companies are built based on what the discount you offer. So, you know, in order to move up the rankings, one of the keys in that is the discounts that you offer. So for some operators, that's the only way for them to be noticeable, and so they had to you know, do the 50% and join the delivery companies on some of their big campaigns. So that's obviously difficult. It erodes your margin, and then, you know, again, you don't have the power to then go and reach out to that customer again. It's, you know, you're constantly working with third-party providers. So you need to find that balance and really think a little bit more long-term. The worry right now is that people are trying to make up for this shortfall in revenues right now. And if that's done too long through discounts, it is going to obviously really impact the industry.
Right. Another question from someone in the audience. At delivery partner exclusive kitchens, do they cover all cost kitchen equipment and operating supplies, or is it any cost shared by the tenant?
Sometimes it depends. It depends by company, by market. Most of the time, if it's general equipment, they might, or the previous tenant or someone, they might have a few fridges and a few things like that already built in. They'll have an exhaust hood. They'll have just the basic M&E services. Then in our case, for example, we'll have more specialized equipment. So then that's up to us to bring that in. But for a young startup, if you're looking at just opening in a cloud kitchen, sometimes the equipment that they provide is already enough to get you started.
Great, thank you. So Adrian, my question as well is, what are the challenging markets that Salad Stop intends to venture into? Probably you can share with us as well.
As in new markets that we would go into?
New markets, exactly.
Yeah. So I think part of it is really our bandwidth and what we can handle as a business. So I think anything outside of Asia right now would be challenging. It's also something that we might not be that familiar with. We understand this part of the world. We grew up here. We worked in Asia for a very long time. So I think that would be the first. The second, I think, would be markets that are maybe already highly saturated. You look at markets like Dubai. We looked many times at Dubai, but it's a relatively small market and incredibly competitive, higher rentals, everything. So unless you find the right partner, that becomes a difficult market. So I think the rest of the world, again, I think that we see huge opportunities in places like China, obviously. But then it's is it the right time to enter? Do we have the right partner? There are a lot of questions. I think the bigger the market, obviously, the more attractive it can be, but the more challenges you might encounter. And I think we feel that we really need to be ready to tackle a market like that. And I think we already have enough on our plate just in Southeast Asia, where we, again, have 3 brands now that we can deploy and go much deeper into those markets rather than spreading ourselves too thin.
Great. You, interestingly enough as well, you mentioned about investing in your own technology. So that's one of the advantages of cloud kitchens. So what is your advice to potential businesses who wants to delve into cloud kitchens?
So I would say in the beginning, it's obviously the best to just work with different solution providers. So for example, a few that have popped up, especially during COVID. One would be Odle. So they're really just a platform. You list your products. They have a full integration with Lalamove. So it's really easy. You're up and running right away. But again, you collect all the data. You have the email addresses. You can retarget those customers. Chope started their own delivery service as well. So you now have quite a few options out there. YQ, everyone has offered restaurants the options of doing pickup or delivery. So I would really just try to be on everything, basically. I think that learn as you go along. The third parties obviously offer a marketplace that others don't. So if you have a good product and there's a gap that you're filling, that can be a great start as well. And I think we've seen that in other markets, particularly Hong Kong, where there's some pretty obvious gaps in the market in Hong Kong, and you can fill that just by being purely online to start with. And I would say that's really just the right way to start, is really trying to work with different platforms. And as much as possible, once you build a little bit of traction, is to work with platforms such as Odle. And in the future, if you can build your own or buy something off the shelf, I think it gives you, again, better margins and gives you even more control over your business.
Amazing. Thank you so much for that sharing session, Adrian. Thank you, Salad Stop. Thank you, Fresh Creation Holdings. And thank you, audience, as well, for joining us for today's webinar. So if you'd like to reach out to Adrian, either through Spectrum, or Adrian's available on LinkedIn as well. So audience, please fill up the feedback form once you exit from this webinar to help us to, have new sessions which are as good as this webinar as well. So join us next Thursday on Digitalizing Manufacturing, a panel discussion to delve into digital infrastructure, benefiting the future of manufacturing to meet Industry 4.0. So I'll see you next week. And thank you again, Adrian. Have a good day. Stay safe, everyone. Thank you.
Bye.
Bye.